Today we are talking about Money 101. We all love these big commission checks. Most of us will put some on the side for the taxes, but we forget about our retirement plan. Today, Jayne Hall with Five Rings Financial will help us and answer any question we have regarding retirement plan. Hi, Jayne.
Hi, good morning. Thank you for having me. I'm good. It's a beautiful day.
It is a beautiful day here in SoCal.
Yes, really.
70 degrees. We love it.
We love it.
So let's start with an easy question, which is what type of retirement plan are available for real estate agents?
Well, real estate agents are 1099 typically employees.
Mm-hmm.
And so you can go into an IRA, you can go in 401k, you can do a Roth. All of these, you would need to be talking to your tax person to figure out the best one to do. But those are all available for us.
So that's good. There is many options for a real estate agent to have planned to save money. Now, can you tell me a little bit about traditional IRA?
Well, your traditional IRA typically is for somebody that's a W-2 employee, but for like a 1099 employee like myself, we would put money into what we call a 401k or a SEP IRA. That's for an individual employee, a 1099, and you would probably go to an investment advisor with a Schwab or a Merrill Lynch or somebody like that. We are not like that. That's not our platform. We'll get to that in a little bit. But so those are available for people to set money aside for future financial needs. You could also put money in a bank account, but typically the interest rate that you're getting there is not going to make a big difference.
Like the CDs, right?
Right, the CDs, we'll get to that too.
Okay. Yeah. So what about a Roth IRA?
Well, a Roth IRA then is, so your traditional IRAs are pre-tax dollars. So I get my check, okay, and I have to pay taxes on that money, okay? Or I can set some of that money aside. So let's say I have a $1,000 check and I take 20% of that check and I put it into a pre-tax account, okay? So that's just going to set aside till I retire at 70 and a half. Then Uncle Sam wants his money or her money. And versus the Roth, which is an after tax. So I get my $1,000, I take my 20% and I just go put it in an account. I pay the tax on that 20% already.
Okay.
So there's an example kind of that I use about this, the seed and the harvest. So you're coming into my shop to buy a bucket of corn because you're going to plant corn. And I tell you, you know, Jessica, if you pay me the tax on this bucket of corn today, when you harvest your corn down the road, you won't have to pay tax on that at all. So which would you rather pay, the tax on the seed or the harvest, right? So that's kind of what a Roth. That's how a Roth works.
Okay. Now, when do people really start a retirement plan?
Well, I don't like to tell you this, but the average age that we know that people start saving is 53. So don't feel bad if you haven't started and you're already at that age. But, you know, we have children to raise. We don't think we have the money. We're not thinking about it. It's not our priority. And then when the kids grow up and they leave the home, we go, now I can turn around and look at me. So don't feel bad if you haven't started. We start people with a little bit of money over a period of time, and we have different plans that we can talk about. If you want.
Yeah, I think what's happening is when you're in your 20s and 30s, you think you're strong and you're going to make millions and millions of dollars, but you don't think like how fast you get to retirement.
Right.
You wake up one day, you're 50, and you're like, oh my gosh,
right.
I didn't save any money.
Just watch how fast your children grow. I'm watching my grandchildren grow now, so it's like, oh my gosh, weren't you just like this big yesterday?
Right? Yes, so, it does go fast. So 53. Right. Wow.
Yeah, 53. So don't feel bad if you haven't started out there. You're good.
If I was guessing, I would have said 30. 30, 35. That's when you start having your family. And
this is an average, so there are people that don't
okay.
start till later, but there are people that start earlier. So yeah.
Okay,
so
53.
Good. Yeah.
So now, real estate agents have to put aside an average 25 to 35% of their gross income for Uncle Sam. Now, How much should they put aside for retirement?
Well, that's really a depend question. It depends on what you want your financial future to look like, how much money you're going to think you need. You've got to factor in inflation. So that's where I come in. I'm kind of the counselor, if you will. We'll sit down and we run some numbers on, what we think you're going to need it when you're 50 or 60 years old, or whatever age you'd like to retire. I thought I was going to retire a long time ago when I sold my business, but I ran out of money, and the average 401k only lasts 7 years. So we've got to do a little bit more calculating on that.
And I think when it's hard too with real estate agent like us is we don't have a regular paycheck. So even saying, okay, we put 10% every month, well, maybe we have a good month and we can put a lot of money. And some we have a bad month and we're not able to put anything on the side.
Exactly.
So I think we just need to have a formula that is commission based and not like maybe a monthly formula.
Right. And the position that I'm in, I'm also, we talked about this, I'm also a licensed real estate agent. So yes. I have experienced this for the last 13 years. And it's the same with the company 5 Rings. I am on a commission only. So it's like, yeah, you have a really good month and you have to have the fortitude to like, okay, let me write this big check out right now. Well, let me write this
not
check
buying
out
a
right
brand
now.
New car.
So yeah, let's wait for that and put some money aside for savings, right?
Uh-huh.
So yeah.
Yes. Now, where do you think real estate agents should reduce costs and save to put aside for retirement? Example, like car payment, maybe. I know we like to drive fancy car, but
right.
maybe we should cut costs on our car payment, or
right.
it can be something like going to Starbucks every day.
Right.
What do you think
well,
about that?
And that we have what we call a $5 a day plan. We also have what we call our funnel. So we'll sit down with you and we'll review your insurance policies, your auto insurance, maybe your life insurance, your homeowner's insurance, your expenses, to see because we have partners that we can farm that out to, and if we can save you a couple of dollars on the money that you're already spending, we can then take that. So let's say you're spending a couple $100 on all those things, and we can save you $50. Well, guess what? We just found you $50 that you can now put aside for your, quote, retirement, or your trip, or your party, or whatever it is that you want to save for, because you're already used to spending that $200, and now we've reduced it to $150.
So you're not changing your lifestyle.
You're not really changing the lifestyle. The other thing that we talk about is the $5 a day. I'm sure you've heard the book. There's a book out, the latte or whatever. So let's just say you go out there every day and you have one of those, and it's $5 or $6. Well, if you stopped doing that, like even twice a week, then you multiply that times 30 and do the math, and it adds up. That $5 a day, when I tell people, okay, you can save $5 a day, and then they go, yeah, I could do that. I could save $5 a day, and then all of a sudden they stop. Well, wait a minute.
We don't do it.
That's $150 a month. I can't save $150 a month, but you just told me you could save $5 a day. So see, it's all in that perspective that we have, that we go through our head and we go, no, I can't do that, but you could. Right?
I think it's also a mindset. If someone just take that $5 a day from our account and we don't see it, but we have to be the one. We are the one in control, and we have to be the one that, okay, I am putting that $5 aside, and that's the hardest part.
So the bad news is that as a real estate agent, you're getting a check, and you are in control of that check, as opposed to Jessica, could you just take $200 out of that check and put it aside for me? And we don't, in the real estate industry, we don't have that typically. We have to have our own fortitude and our own, will to put that aside, right? Yeah. So it's one of those things that you have to do it. It's not fun a lot, but I guarantee you, when that money starts building up and it goes from here to here, you go, wow, I did it. Right?
And I can even remember my first year in real estate. When you get your check, if you make a $10,000 check, you're going to spend $11,000.
$11,000.
Not 11. We don't have that mindset. You know, you used to be an employee, now you're an independent contractor.
Yeah.
You just got your first big check, $10,000. I never had a check of $10,000.
Right.
Woohoo, let's go spend it.
Exactly.
Oh, I remember this.
Yeah.
Oh, no. Do not do that if you're a new agent. Do not do that.
Yes.
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 So now, I know earlier you and we talk about compound interest. Can you explain them what it is?
Okay. So when I was little, my grandmother took me to the bank and we opened a little bank account and I got this little passbook. And then she explained, okay, so you put the money in, they give you a little bit of interest. And then the money that you put in that gets interest on the interest. Okay. That was the last thing I knew about compound interest. Okay. Never even thought about it. So that's kind of the premise of compound interest. And so I can show you an example of some triplets that inherited some money from their grandpa on how money can compound, if you want me to show that.
Yes, can you do exactly what you did with me earlier, and we're going to show it to them.
Okay. All right, so
right here.
Just we have three triplets. They are 29 years old, and grandpa just died, they found out, and they each got $5,000. And in his instructions, he said, okay, you have to put this away in an account, and you can't touch it until you're 65. So our first triplet, she goes to her bank, and you probably can't see that very well, but she puts her money in the bank, and she's getting 4%. Now, the way that you figure out how money doubles is we call the rule of 72. So your money will double for you divide the interest that you're getting on your money into 72. So if you are getting 1% in a CD, how many times does 1 go into 72?
72.
72. That means that this dollar is going to turn into $2 in 72 years. I don't know about you, but I'm happy I have one 72-year period. So the first gal, you can see there, she gets 4%.
I think it's on the, is it?
It's over
here.
It's on the opposite
4%.
side.
Yeah, I'll show
okay,
it.
so 4 goes
Right
into 72 18 times. So you can see she's going to double her money at 47, and then at 65, she'll have 20,000. Okay, so her sister.
That's not a lot of money.
That's not $20,000
now to retire.
Right.
Nope.
And then her sister, she finds an account
right here
in the middle. We're going to go to this one now. She finds an account that she can get 8%. Okay, if you can see right there, 8%. 8 goes into 72. If I remember my 3rd grade math, 9 times. So her money's going to double every 9 years. So you can see she's outperformed her sister pretty significantly. She goes at 47, she's equaled her sister, and then at 65. Now she's got 80,000. Now that a little difference or a big difference? Well, if I'm getting a commission check of 20,000 versus 80,000, I'd say it's a pretty big difference, right? So that's
for 8%, right?
That's for 8%.
Okay.
Now, sister number 3, she's a little crazy, and she finds somebody that she can get 12%. Now, you say 12%, where am I going to find 12%? Well, back in the 80s, I was investing in trust deeds at 30%. Of course, I lost the money, but that's a whole nother story. So you can see on the last one over here, she's at 12%, so 12 goes into 72 6 times, so every 6 years, her money's going to double. So you can see when she's 65, she now has 320,000 versus her first sister at 20,000.
Way bigger. 20,000. And 20,000 is 4%. It's not even CD value, like what, 1%?
Right. So what we are showing you here is that small amounts of interest increases can make over a period of time a very big difference in your bottom line. Now, there is an account out there that's 18%. I didn't pull up. 18% guaranteed. Now, you probably have one. If you're a guy, you have it in your wallet. And if you're a woman, you have it in your purse. It's called a credit card.
Oh, no.
So if you charge something on your credit card and you do not pay it back, you get at least 18 and maybe sometimes as high as 25 and 30%.
Oh, yeah.
So try not to do that because that will really put you under, especially like with student loans when you haven't paid those back. My son is still paying.
Student loan.
Student loan.
Credit card, student loan.
Credit card, student loan. So
have to get that out.
Anyway.
So now let's talk a little bit about your background.
My background. Okay. I graduated college way back when with a degree in dental hygiene, and I worked in that field for 30 or 40 years. And during that period of time, I started an engraving business on my kitchen table because my kids were playing soccer, and somebody called me and said, "Hey, can we get trophies?" And so anyway, that led to 3 stores eventually. I sold that in 1995, thinking I was going to be able to retire on that money. And lo and behold, I'm like your average 401k will last 7 years, and then
won't go forward.
There I go. So then I decided I'd like to get into real estate, so I got my real estate license, and I'm still a licensed real estate agent. Transitioning from that into total money now, and so I've been doing that since I got my license real estate in 2003, and then in 2008 I got my life insurance license.
So what I like about that is you understand where we're coming from as real estate agents.
Exactly. Yes, I get these big checks, and where are they? So I have really tried very, very hard to follow my dad. When my dad gave me my dollar allowance, that was way back when, and he gave me a little book to write it down in, and he goes, "Okay, you can spend 80 cents, 10 cents you're going to put away for your savings, and 10 cents he told me you're going to give to church. Now you can take your 80-10-10 any way you want, but when I saw that 10 cents starting to multiply, I found that I was making my 80 cents go to less, right? So I was spending less and putting more in the savings. It's kind of exciting when you watch your money go. So the best thing you could do that I could tell you is pay yourself first.
Yeah.
So pick out a number out of your check, whatever the number is. If it's 10%, if it's 20%, write that check out and put that money aside for your emergencies.
And sometimes it's just a small amount makes such a big difference.
Well, and we showed that, right?
Yes,
in that little example.
I know when I met my husband, he used to make fun of me because I used to put like $20 on the side every 2 weeks, and after I went to $50, and he used to always look at me, "Where do you think you're going with your $20? I'm like, you'll see. It's been 15 years now, and I'm still putting now more, but I'm looking at that money 15 years later. I'm like, you see, now you're happy we have that money on the side. And of course, that money has been making babies for so many years.
Right.
So
well, it'd be interesting to hear back from your agents what they are doing and how they could help. We could all be a team here, and we could all like brainstorm, if you will, on what you're doing and are you successful and what have you found. Okay. So that would be a really interesting feedback too.
And there's a lot of apps, and maybe we'll do a show one day on the apps, but there's some apps out there that withdraw money directly from your account, so you can put that into a retirement plan.
Right.
There's a lot of new technology for that. Now, let's see if we have any question. I have some question here. Hold on. Question number 1. What's the best, most flexible college saving plan available for my family?
Okay, so most of you have probably heard about a 529 plan.
Yes.
Okay. And there again, that money that you're putting into that plan is going in to be invested in the stock market. So it has the ability to do this. But because you're starting so young, you could do this a little bit and hope that you're going to end up like right here. Now, the market is right now at an all-time high, but you saw what happened in the last couple of days. It went drastically down.
Yes.
The other thing with a 529 plan is that when your child is ready to go to school, there are certain qualifications that they have to go to school. Like if they wanted to go to chef school, it's not covered.
Why not?
I don't know the ins and outs.
I did a culinary school.
Yeah, but your 529 plan didn't pay for you to go. So the other thing that it does is it adds to your assets. So when you're going for your FAFSA loans, your student loans, that's added to your asset. We have a plan where I'm doing this for my grandchildren, and I have clients that are just putting $50 a month away for their grandkids. So when they turn, basically, it's not, they go to school at 18, so they can still get their loans, right? But we're not going to withdraw the money until they finish school, because you get your loans tax-free. Okay, there's no tax on that. So when you get out, you have a certain period of time to pay that back. That's when we withdraw the money from the money that you put aside for the plan. So it's kind of a 529 on steroids, really, because there's no restrictions on where you can go to school. And basically what we do is we kind of forecast, okay, what it's going to cost for that child to go to college, and we withdraw the money. So that's a whole, I could have a whole day on that one.
What's the average interest on the 529?
Well, I don't know. I can't say on a 529. On our plans, it's about 7%.
That's not bad.
Over that period of time.
Over that
period
it'll
be up and down. It's based on the S&P index, but your money is not invested in the market.
Okay. And now you can use that money only for college, or can you use for like first home?
You can use it forever. You can buy a car with it. You can do whatever you want with it.
How does it work with it about taxes? Like, is it like you do?
Well, you're not paying taxes on it because you're withdrawing the money as a loan from this account.
Got it.
So it comes to you tax-free.
Okay, tax-free.
I like it.
We like tax-free.
We like tax-free.
Question number 2. How can I take money out of my business for retirement, grow it tax-deferred, and access it tax-free? I'm going to repeat it just in case.
Okay.
How can I take money out of my business for retirement, grow it tax-deferred, and access it tax-free?
Okay, so here again, I go back to the Roth on steroids. We have a plan that we can set aside after tax dollars, okay? And you're putting that money away. So you're deferring the taxes on that. And when you get to the age where you need the money or you want the money, you go in and you literally borrow money from yourself. That's how it's set up. There's now a Roth, you can only put like 55 or 60.
You can do like a promissory note to yourself?
Yeah.
Oh,
isn't that cool?
Oh, wow, I just learned something.
Yeah, so
I don't pay the 10% penalty.
There is no. We're not in the IRS things here. This is totally different from IRS. So you set money aside. Okay. Now there's different ways to do it, and each person is going to have a different scenario. So that's why we sit down with you and we talk about all of these things. But for me, I'm putting money away now, and when I actually need it, I can go in and literally borrow against it. Okay. Now, it is attached. Here's the caveat. It's this particular one that I have in my head right now is attached to a life insurance policy.
Okay.
But let's say I have $1 million policy. And I have.
And we're not talking about term, right? We're just talking like regular.
Right, well, in this particular case, we're talking about a permanent policy. Okay. So it's got $1 million death benefit, but the cash value has grown to $750,000. So I need some money. So I go in there and I borrow $100,000. Okay. Now this company is sending me the check for $100,000. There's no tax taken out of that. I'm borrowing against it. What's really cool is because that $750 is still on the books, they're still paying you interest on the $750. Unlike if I had the $750 in the bank and I borrowed $100,000, now that's reduced to $650.
But you're talking about life insurance.
This is this particular thing. This particular way. So that's where that question leads to. So, like I say, every case is different. Every person is different. Every person's vision of the future is different, and everybody's. You've got your rent. I've got mine, and so it's going to depend on each individual how we set that up.
Okay.
But it is available for sure.
Okay. How do I benefit from the upside of the market without the downside risk?
Okay, so here again, in this particular policy that we were talking about, and I'm going to call it a policy, the money that is in there is not invested in a stock market fund, a mutual fund, or anything like that. we base it on the index. So if the stock market index goes up, the S&P, your money is going to go up. Okay? Now, let's say the market goes up 10%, okay? You're going to go up maybe 8%, because this is where insurance companies, this is where they have their money. The 2% that they're taking off the top of your money is going to pay me. It's going to pay their advertising, their office, and all of that, okay? And we're talking billions of dollars. So here is your account. The market's gone up, so you go up with the market. Now, the stock market goes boom. Yeah. And guess what? You just stay here. You just stay level. And you go, well, zero? You're not going to give me anything? I go, well, is zero better than 54% down like it did in 2008? Yeah. So it kind of looks like a stair step up. We can go into that more if you have more questions on that. That's again, that's a whole program for a whole, another session. Okay.
Thank you, Jayne. You were talking about how to start. You have like a $5 a day saving program. You want to talk about it?
Right, and we talked about that a little bit before. So we show you how to literally, can you give up the two coffees a week? Okay, there's your $5 a day. And then,
if you don't want to give up your coffee every day, just you're here to help them, or
make it yourself.
Make it at home,
right?
Are you going to review all the insurance and everything they pay every month? And
right.
Try to
and do that. And we put it in the funnel, and we see if we can save you some money on your home insurance or your car insurance or any of the other expenses that you're already paying. So we call it refinancing your financing. So it's like when you have a mortgage and you want to lower the payment, what do? You refinance it at a lower rate of interest, hopefully. Right?
Or you just take that extra money and go spend it.
Well, that too.
That's what's happening all the time. Do not do that.
Right.
Thank you, Jayne. Do you want to talk a little bit about Five Rings Financial?
Well, let me just say this about Five Rings Financial. We've been around for 35 years. Mike Wilk founded us 35 years ago. Our corporate office is in Littleton, Colorado, but we have offices now in 40 states. And we're kind of like a Merrill Lynch or a Schwab, but really not. And the reason is that we don't require you to have $100,000 to open an account. We start you with as little as $5 a day. And secondly, we don't focus on millionaires. We focus on the hard-working middle Americans. Now, we do have millionaires as clients, but our focus is education of middle America, who typically doesn't get the financial education. When was the last time you learned about compound interest? Like me, when I was about 8, when I went to the bank with my grandma. So that's our premise. We're education-based. We do programs all over the country, just about every night of the week, and we call it Money 101, just like here.
Just like here.
And we do them virtually, and we do them live. So if you would like an invitation to one of those, I'd be happy to, just go through Jessica, and we'll get you the calendar. You can listen in your jammies, and it goes through a lot of the principles that I talked about today, but in more depth.
You are located in Carlsbad.
Our office here is in Carlsbad, California, and like I say, our home office is in Littleton, Colorado, but we are in 40 states.
40
Texas,
states.
And I noticed that you guys have agents in like 13 or 14 states now.
15 now. 15
so there are a number of states that I looked at that we do have live events. So if y'all are interested in attending one of those, I'd be happy to get you the lead to that.
Yes, thank you, Jayne.
Okay.
Thank you very much.
Okay.
Any last tips? Anything?
Any last tips? Okay, I have an offer for you guys. This book can change your life. I'm happy to send that to you if you send me your information. This is one of our agents here locally. She wrote this book to help you with money principles and understand. Patrick Kelly wrote this book called The Retirement Miracle a number of years ago.
I like the golden
the golden egg right there.
Pretty cool.
And it's things that are mentioned or talked about in here that we never learned in school. We go to school for 12 or 16 years. And when was the last time they taught us how to balance a checkbook, how to raise kids, how to stay married? So we're only going to do the money part of it. But I want to thank you again for inviting me. This was fun. I'd love to do it again. If you have any questions, I think they've got my contact information up there for you. I'm happy to help. Yeah.
Thank you, Jayne, very much
thank
for
you.
educating our audience.
Oh, I'm loving it. Okay.
Bye, everyone.
Have a great day.